Hello guys, Trader Michael here, and today we will talk about how to calculate your position size correctly to not blow up your account. And I will try my best not to make as many boring calculations, but hey, since this is the trader stuff and the math is very important here, so we will have to do some of them. So yeah guys, without further ado, let's jump right into the topic. So guys, most probably you already know that in trading in Forex we are dealing with the lots. This is the standard unit for measuring the volume of a currency position. And as you can see on this example, right here on this chart, we have the standard one lot represents the 100,000 of a currency units, the mini lot, which is 0.1 lot, it's a 10,000 currency units, micro lot 0.01, it's a 1,000 currency units, and nano lot, which is only 100 currency units, and it is 0.001 of the whole standard lot. But we will not deal with the nano lots because they concerns only the cent accounts, and of course LiteForex offers a cent account, but not in every country. So you need to ask your account manager for the offer of a cent account because maybe it is not available in your country. So yeah, we will just be dealing with those calculations between this range. And this concerns only the trading on currency pairs. If you want to check how big is the standard lot for example, the commodities and indices, you need to go for the LiteForex website, the Trade Forex tab, and check the trading assets. And for example, if we go to the metals, we have the information that, for example, contract size for the gold is 100 ounces. So if we check the charts, we see that, for example, price is about $1,700 for 1 ounce, right? More or less. And if we multiply that by 100, then we will get 170,000, right? So that is why most probably you saw the difference when you were trading the same position, the same amount of volume on the currency pair, and then try it on on gold, trading gold, and therefore you could see that the changes from the price movement are way bigger on gold than in the in trading the currency pairs. So now maybe let's switch to the platform and do more calculations. Okay guys, so maybe let's examine some real example. We have the screen from the platform, and we have this very completely imaginary situation. This is the Euro USD currency pair chart, and for example, we have this inverted head and shoulders here, and we think that the price will go up. So we should calculate how we can risk in this situation. So our entry point would be somewhere around here, right? And our stop loss would be somewhere around here. And the distance, let's maybe mark it. This is our entry point and our stop loss. The distance between entry and stop loss is 35 pips. I measured it before, so you need to trust me. Okay, so how do we calculate that? Let's assume we have $100 in our account, considering that we should at least risk 3 to 5% having such an amount in our account to have the risk in our control. 3 to 5% per trade, I think, is good. So in our situation, that would be $3.50, right? So in big shortcut, I will tell you that one lot equals $10 per 1 pip, which is in our situation 35 pips. That would mean $350, right? So that is way too much. Micro lot, sorry, bad writing. Micro lot, which is 1/10 of one lot, it is $1 per 1 pip. 35 pips, $35. Still too much, 35%. $0.01 lot equals, you probably guessed it, 10 cents per 1 pip. Okay guys, so now what we should do is to, of course, check what we can risk, and the second thing, what we need to risk, which is how much we are in account, and calculate this. For example, let it be 3.5% risk per trade, and divide that per the range of between our entry and stop loss, which is the amount that we are risking for this trade, right? So 3.5% for our from our $100 account will be, of course, $3.50, $3.50, and we need to divide that by the amount of pips that we are risking, which is 35 points, and that equals 0.10 US dollars per pip, per pips. Okay, so that means that our position should be 0.01 lot, right? So this is the this is one example. So guys, let's maybe check other example, right? Let's delete all that. Okay, and for example, let's from 35 pips, let's say we have some small scalp for 15 pips of the stop loss, right? So again, what we should do, we are examining that we can still, this is our first trade, the second one was closed, so again 3.5% per trade, so we have our 350 again 350 divided by 15 pips, and let's check how much it will be, of course. So it equals 0.23 US dollars, which is 23 cents per pip, but to calculate the volume we need to round it up, so it will be 0.02 lots per trade, per this particular trade in this situation. So that is basically how you calculate it. You should first plan the trade, which is plan the whole thing, plan the whole setup, and then with this simple calculation check how much you can risk at this particular trade. Because if it is an intraday trade where you are trading on for example 30 time frame, 50 time frame, then you will be having the trades like with a stop loss of 15 pips or something like that. But if you are trading, for example, on a daily charts or 4-hour time frame, then the stop losses would be sometimes even bigger, like 30, 40, sometimes 50 pips. So then you should take the lowest amount available if you have, for example, this amount on your account. Okay guys, I think now is the time to summarize the video and couple last touches to it. So, as I told you a second ago, first thing first, you need to plan your trade. You need to have the specific plan, what you are looking for on the market, on the chart, according to what you will place a trade. So that is the first thing that you need to have. And then, as I told you, right, you need to measure how much you need to risk and how much you can risk, and then calculate your position size. So second thing, you need to focus on one asset at a time. You need to master it. You need to learn how the asset fluctuates during the trading session, and how the price changes and moves between the support and resistance levels. and then gradually you can add additional assets to trade. But this is the key thing, to learn one asset at a time. If you will try to master four charts at a time, you will just be confused, and then you will start missing opportunities. For example, on this one, because you are checking the for example, you will miss the opportunity on euro dollar because you were for the last hour was checking the pound USD chart, and therefore you will be just frustrated, and you will not learn anything. So focus on one asset and then gradually add one at a time. Okay, and the third point is to take 2-3 trades per day to keep the risk tight in the boundary of 10% per day, because this is a very important thing. Since if, for example, you took 3 trades during the particular day and all 3 went red, there is a high probability that the 4th one will be no different. So you need to step back and examine. Did you trade according to the plan? Is it the problem with the plan, or it is the problem with you? So there are many dependencies in this particular situation. So to keep the numbers in tight, to keep the risk in control is very important. And I'm saying to this especially to the traders with the smaller accounts and to those who are just starting their trading journey. And the fourth thing, it's the explication of the third point, which is to run your trading journal. This is one of the most important things in your trading career, to check your trades, to analyze them, what went wrong, what was good. As I said previously, did you trade according to the plan, or is it the problem with the plan, or is it the problem with you, that you are not behaving in a particular way to trade according to the rules of your trading plan? So this is very, very important to have this trading journal and to keep control of yourself, because we are just human beings, we are not robots. So we need to have some diary of a trader to control our trades and check what was good and what was bad, what we need to improve. Okay guys, the fifth and the last point is to just start small. There is no need to put bigger amounts on your account when you're just starting to trade, and the best way to learn is to start with the smaller amounts. You need to have the real money to feel the pressure when you're opening a position. This is very important in the learning process, but it is a step-by-step process, and it takes sometimes from 1 to 2 years before you start to making some profits. And you need to prepare for that the first money that you put in your trading account, you will lose them inevitably in one way or another. So the best way is to start small and then gradually add some funds, or build your account when you start getting to be profitable. And this is why you see the statistics that 80 to 90% of the traders fail. They lose their money. It is just because they are not willing to put time and effort into learning, and therefore they fail in their mission in the beginning. So this is the fifth and the last point. I guess that is all for this video, guys. I know I'm not the best teacher, and I know that my writing is not the best also, but either way, I hope you learned something, you get something out of this video, and thank you for watching, and see you in the next one. Take care guys, bye bye.